Welcome to STRAT this week. I'm Mike Warford. With me is Mike Rarey. Let's get into it. Mike, we've got a holiday shortened week for the bond market, even though equity markets were open the entire week, but we can check in on performance through Friday the 13th. We'll start with the equity markets. Anything notable here?
It was a volatile week day by day, but overall for the whole week, large cap equities ended the week about the same place they started. So not a lot going on there. Still down firmly since August 1st.
Yep. How about on the alternatives front?
On the alternatives front, that's where you're seeing more of a typical response to the conflict going on in the Middle East. You look at energy prices up 5% last week, precious metals up 5%. So this is where you start to see that safe haven demand within financial markets.
Right. Yep. Yeah. And speaking of that safe haven demand, that can take us to where we're going to spend most of our time talking in this week's video is on the bond side.
Yep.
So, we can see more green here for last week, especially in the long portion of the curve, 10-year up 1.5%, 30-year up 3.3%. In our view, that short-term performance being driven by that safe haven demand that you referenced. But really, that's just a small rally from this route we've seen since 8/1, particularly in the long end of the curve.
Yep.
So you see, the 30-year down over 11%, longer-term bond yields up about 70 basis points in that time, a pretty significant move, right? Certainly more significant and quicker than we thought it would be, than most people thought it would be. And so what we thought we'd do today is dive in on why this performance has been happening and what our outlook is for each of those factors that have been driving it. And, we think this is particularly important because, this performance since 8/1 has been referenced as one of the primary reasons equity markets have been down so much since 8/1. So notable knock-on effects from these changes in bond yields. So let's dive into it.
Yeah.
Let's start with some of these factors. The first one being economic growth. Right? So maybe if you want to talk through what's been going on with economic growth projections, what's our outlook, and how that could impact bond yields going forward.
The economic data in Q3 has been the big surprise. We've talked about it over and over again. Atlanta Fed GDP nowcast, which at this point in the quarter is relatively accurate, is running near 5%. That absolutely blows all estimates out of the water. Heading into the quarter, economists were expecting somewhere around 2, and to get 5, part of it was certainly Taylor Swift, but that's not all of it. Beyonce was in there too. No, but that has really been the big shock to expectations, a growth shock, if you will. So that's one reason.
Yep.
And then as that happens, recession probability falls. Right, that's his same side of the coin or other side of the coin. And so falling recession probability, that also boosts longer term bond yields.
Right, exactly. And maybe a potential knock-on effect, but certainly an impact in its own right is inflation, right? Potential for inflation to be maybe stickier, maybe start increasing again. That's obviously had an impact on longer term yields as well.
And a lot of that is related to economic growth.
Right.
Particularly commodities prices coming back up, energy prices. But we're going to dive a lot more into that when we get into the framework updates. But that's certainly been a factor as well, pushing up longer-term bond yields.
And then how about Treasury issuance? We've talked about Treasury issuance a couple of times in the past few weeks. What's going on there? What's our outlook for that factor?
Bigger budget deficits, bigger fiscal deficits here in the U.S. means more Treasury issuance. And we talked about in prior video shoots how the Treasury is going to be issuing more and more longer-term paper, 5-year, 10-year, 20-year, 30-year bonds and notes in order to fund the deficit. And so from a supply and demand perspective, that's going to result in longer-term bond yields, maybe having some upward pressure on yields, downward pressure on prices. And we're seeing more and more evidence of that. We talked a few weeks ago how we knew this was coming, and we knew that we sort of lack the political solidarity to come together and reduce fiscal deficits, so we're going to have to live with this. But we hadn't seen a lot of signs yet of disruptions in the market. We actually hadn't seen longer-term Treasury issuance pick up that much. And last week we started to see that. Although last week was a great week for longer-term bonds, Thursday was an awful day. And the big reason for that was if you look at the 30-year Treasury auction, very weak demand. So for those of you following at home, there are a few ways you can determine if a Treasury auction was strong or weak. One, the classic is bid to cover ratio. You know, if the Treasury is going to auction off so many bonds, how many bids do they have for that? A lot of bids. So high
More
bid to
bids,
cover
better
means
auction.
more demand, but the bid to cover was pretty weak. But that metric can be it can be messed with, it can be manipulated, so we don't trust that as much. What's more important is you look at the trade through versus tail, which we had tails. We had big tails. And what that means is you look at what the yield on the 30-year Treasury was right before the auction, and then you look at through the auction what the high yield was that was awarded. What's the difference in those yields? And if it's worse, you know, the yield ended up being higher than right before the auction, that would weak demand, and that would be called a tail. On the 30-year auction, we had a 4 basis point tail, which I know doesn't seem like a lot, but that's the most we've had in years.
Yeah.
And then the last thing we look at is, well, who's buying the debt? You know, you have direct bidders, indirect bidders. If you get bids from them, you know, foreign central banks, investors in the U.S., bids from there, that's generally seen as a sign of strong demand. And then the primary dealer banks are the ones who have to deal with the rest of it, right?
Yep.
So primary dealers had to take down a lot of that 30-year auction, about 18%. That's a lot more than prior auctions. So we talked about as the Treasury issues more longer-term debt, somebody needs to buy it, and the primary dealers are going to be stuck with it. All the big banks are stuck with it. So very weak auction. So we're seeing more signs of that, and that's just going to be something we're going to live with unless somehow we all work together on Capitol Hill and, you know, reduce the fiscal deficit.
Yeah. Don't get greedy now.
Right.
So yeah, a couple of factors there, right? Economic growth, reduced risk of recession, inflation expectations, Treasury issuance. You know, we obviously have outlooks for those items. We'll dive in the framework, but you know, one factor here that is maybe at a turning point, maybe has some confusion around it, is this idea of higher for longer from the Fed. You know, we saw in the September dot plots, the Fed penciled in another hike, one more hike in 2023. So either coming at the November meeting or the December meeting. But the market seems to have taken that probability off the table, certainly for the November meeting.
Yeah. And that's been, that higher for longer idea has been pinned as the biggest reason of all the reasons we just talked about why longer term bond yields are up so much.
Yeah.
But you get to the point where last week we start to hear some Fed speak, Fed officials coming out and saying, well, hey, if the bond market is going to raise interest rates for us, then we don't have to hike. So now you introduce this sort of self-defeating nature of higher bond yields. You know, the Fed saying that they're going to raise interest rates again in November and keep them higher for longer is the reason bond yields go up. But if bond yields go up, the Fed then isn't going to hike interest rates in November.
Yep.
Right?
Exactly.
So it becomes very tricky if you're the Fed and you're going to articulate to the market that the market is doing the hiking for you. That will put you in a very difficult position when you get to press conferences and so on. And so we wanted to show what exactly the Fed is talking about here. They're talking about the Fed funds rate, right? Do they need to hike again? That's the blue line. You see where, you know, the path we've been on versus financial conditions, which is a nebulous term. What does that mean? But the idea is the market can make financial conditions tighter, which puts firms, particularly net borrowers, you know, corporations and consumers that are net borrowers, in a difficult position. They slow their consumption. Those businesses slow hiring, slow investment. The economy slows. And so this tightening financial conditions does the Fed's work for them.
Yep.
So have we seen enough tightening of financial conditions to say, yeah, Fed, you're right? And we really haven't seen that much. I mean, you look when the financial conditions index is red, that means they're very tight relative to normal. And when they're green, that means they're loose relative to normal. And what does this mean again? We're looking at stress in money markets, bond markets, equity markets, right? So if equities are selling off, financial conditions are getting tighter. Yep. If in the bond market, credit spreads are widening out, then financial conditions are getting tighter. And if in money markets, things like TED spreads, commercial paper versus overnight swap spreads, if those are widening out, that's tighter. Yeah, financial conditions have gotten a little tighter, but not that much.
Right.
That's why for the Fed to come out and say that, and the market to then run with it to the point where now it looks like a hike in November is off the table.
Right.
Right? Maybe a hike in December. But November was previously penciled in by the Fed in the dot plot, and the market's now taken that away.
Yeah. So financial conditions, you think about it as, access to liquidity, access to capital. Can you get it? How much do you have to pay for it? That kind of thing. The Fed is tightening them on purpose by raising the federal funds rate, but the other factors you mentioned are also potentially tightening liquidity as well. So we're kind of back in that 2012, 2015 period where it's almost what the Fed says is as important or more important than what they do when we're talking about getting to this November and December meeting and communicating around a potential pause or potentially being done hiking.
Right.
And that's an interesting place to be from a market, business cycle, economic cycle perspective. And that's a little bit of what we wanted to dive into here is just taking a look at the risk reward on the table in the Treasury market right now.
Yep.
And what we're looking to highlight here is we don't know if the Fed is done hiking. We don't know when they're going to be done hiking. But if or hopefully when they get to that point that they are done hiking and maybe looking to cut, that's an incredibly attractive time to own longer term bonds.
Yep.
And I think this chart illustrates that because, even though it's been a very painful route over the past couple of months in the high quality fixed income space, that just means you have higher yields going forward. And as we're showing here, a more attractive risk-reward trade-off.
Yes.
You want to dive in on that?
If you look historically, the market's saying the Fed's done hiking. They're done, right? So if that is the case, then you get into the pause phase. In the pause phase, where the Fed doesn't hike, they're done hiking, the next move is a cut, right? Fixed income does reasonably well, far better than they do in the hiking phase. They do reasonably well. Equities typically do okay also. But then once we get into the cutting phase, which we don't know when that'll happen, the market is saying that's going to be further out into the future, that's when fixed income does really well. So from the start of the pause through the cuts, longer term fixed income is the spot to be historically. Far outperforms equities through that entire time period. So looking at the risk reward here, we take the 2-year note, the 10-year note, the 30-year bond. And we look at, say, what happens over the next 12 months? What's your total return going to be? That's the bars. If the yield on each of these bonds goes up 2%, so that's your worst case scenario, that's your dark red, versus going down 2%, right? So the down 2% looks much more like the Fed is certainly done hiking, and so they're in the pause phase, and they're going to be cutting as we get into 12 months from now. And you look at the risk reward for each of them, right? Because yields are so attractive. As a bond investor, you get your starting yield, and then you also get any changes in yield over the time period from capital appreciation. So if you look at the upside to downside, the risk reward, you take the 2-year note. In a scenario where 2-year yields go up another 2% from here, you still make money. You still make 2%. And if 2-year note yields go down 2% from here, you make 8%. So that's all upside, right? And your upside in the bond yields coming down 2% is 4x, right? Look at the 10-year note, it's similarly attractive. You're down 10 in the worst case scenario, up 21 in the best, and then the 30-year bond, very similar. Let's say, you poke at you circle the up 2, down 2 there, even just up 1, going up another 1% from here in the 30-year note, that's the curve uninverting. That we talked about how difficult that would be. You lose 10% over the next 12 months, right? But then at that point, 12 months out, your starting yield would be 6.8, right? Or I'm sorry, 5.8 in the up 1. So you have a very attractive yield. And then if yields come down, you make 43%. So at some point, the risk reward, you're talking about 2 to 4x more reward per risk, versus the upside downside scenario. It becomes so attractive that investors just try to lock it in. And being short, trying to bet against longer term bonds, it becomes expensive. and this really starts to work out for long-term investors.
Yeah, and you kind of compare this environment to even 2-3 years ago before these rate hikes started and the longer term portion of the curve went up, and the upside downside was about equal, right?
Yeah.
About similar downside to upside based on a change in interest rates. So yeah, that rate hike cycle has made high quality bonds notably more attractive going forward.
Yep.
So with that, let's get into the framework. We've got a new visual for our viewers this week on the framework side. Instead of looking at our inflation forecast, wanted to check in on the inflation heat map. What we're looking at here these are not year-over-year numbers. These are 3-month change annualized. So us trying to get a better idea of these recent changes in some of these factors. What should we be looking at here on this heat map?
And the reason why we think it's important to look at it this way right now is because when you look at the PPI and CPI reports from last week, month over month PPI was hotter than expected, producer prices. And that's the second or third month in a row they've been much hotter than expected. Headline CPI, hotter than expected. Core CPI, just about in line. But basically, if you look at year over year, headline CPI bottomed in June, and now it's come back up, right? So over the last 3 months, we've seen some reacceleration in the economy, obviously, but also in inflation. And so this is what that captures. So you look furthest to the right, you start out with headline CPI over the last 3 months, growing at 4.9% annualized, right? Versus in July and June, we were looking at 2.7, 1.9. That was soft landing.
Yeah, they pulled it off.
Right? Exactly. Unfortunately, that wasn't the end of the cycle, right? It keeps going. And now we've seen this reacceleration. Yes, a lot of that you can just say is from energy prices in the headline. And the Fed, we know, is more worried about core, particularly services. Well, we're seeing the same thing. If you look at the services line item, the last 3 months, up 5.4% annualized. Compare that to where we were in June, up 4.1. We were looking like steady progress, right? And now we have this reacceleration. And so this is once again where we think the Fed is going to be in a very difficult position because they've said the market has done the hiking for them. They might not need to hike in November. The market's saying you don't need to hike in November. But I thought you were data dependent, focusing on the labor market and inflation. Because if you're data dependent and you're focusing on the labor market and inflation, we've seen hotter than expected jobs and reacceleration in inflation. And by the way, you've already received the last labor market report and inflation report you're going to get before the November 1st Fed meeting. So data dependent, you should hike again, right? So that's where this is going to be very interesting. And we'll see how that plays out.
Yeah, they've certainly got their work cut out for them. Seems at points like this, the Fed has the track record of sometimes painting itself in the corner.
Right.
It's trying to execute a pause, but communicate what they're looking at during this pause.
Yes.
So a lot of uncertainty and could go a couple of different ways for sure.
Right.
Another thing they'll be looking at, economic growth. We talked about the Atlanta Fed forecast. Anything else you want to add? I mean, obviously our forecast, you see that brief kiss up and then declining over the rest of the forecast period.
Yeah, we're just showing here, we added in another quarter on the front end of our forecast horizon. So this is through Q3 2024 because, the Q3 2023 numbers we'll be getting at the end of the month here. And, in our view, Q3 2023 will be the high point. For we've seen this reacceleration, obviously, but now we're high and falling. And so you take something that's put upward pressure on longer-term bond yields, that's going to flip. And now that should start to put downward pressure on yields.
Yep, absolutely. And then how about on the liquidity front? We've talked about how painful this is going to be, even if it does look like a recovery. Anything notable changing on the liquidity forecast?
Yeah, we noticed that we are starting to see those liquidity strains from the longer-term bond issuance pick up in terms of auction data. We're also seeing it within repo markets. Repo rates, which is something we're not going to dive into here, perhaps at a future video shoot, but we are seeing some pressure there in terms of if these primary dealers are stuck with this longer term debt, how are they going to fund it? Yeah, they need funding, and short-term funding is very expensive. And if they're paying up for all the short-term funding to fund these longer-term bond purchases, do they have the balance sheet capacity to make loans elsewhere? So the banks are going to get the funding, but will other institutions in the economy that aren't the primary dealer banks, they're going to get squeezed. And that's why this liquidity is going to feel worse than it looks just looking at that chart.
Definitely.
Mm-hmm.
And then we'll wrap up on the recession signal front, still inactive. We've pointed to some of these market stress signals in the past, still sitting at about halfway to our credit stress signals. Seeing a little bit of pressure there, but still a little ways away from triggering that signal.
Right. Yep.
And that'll do it for us this week at STRAT This Week. If you have any questions, please feel free to reach out. We look forward to hearing from you, and we'll see you next week.